Hey guys, it's your boy Josh Brown here with an all-new episode of What Are Your Thoughts with Michael Batnick. As usual, Michael and I are going to go through the biggest topics on the street this week, everything that everyone's talking about. Play along in the comments below. Duncan's in the house. We have viewer topics. There's so much to get to. Let's get into it. All right, so Mike, I want to ask you if we just saw a blow off top in Bitcoin or Tesla or both. And do we even agree on what the definition of a blow off top is? Well, how do you define that term when people ask you?
You know it when you say it. Afterwards. I can't you can't know it beforehand, but
all right, 42,000 to 33,000 on Bitcoin. Like
it went lower. It went 42 to 30.
So that's I'm not saying it's the top. I'm just saying that is a blow off top though, right? It happened in a day.
No, but hold on. My point is people say like we're in a blow off top before it happens. Like afterwards it's
that.
Yeah, I'm saying afterwards it's easy to say that was a blow off top. I don't think you can predict it in real time. If you look at Tesla and Bitcoin together on a log scale, like obviously if you look at arithmetic, they're going, it goes straight up given the magnitude of the gains. But even on a log scale, the moves look like, absurd, something that you might never see before or again. So what's the question? Is this it? Is there going to be like a sentiment shift?
Well, blow off tops are rare. Like I feel like blow off tops don't always occur in every uptrend and they don't occur often during an uptrend. But when I look at that chart, it just looks like the definition of a blow off top to me, not in Tesla, in Bitcoin.
So Tesla ran from, 200 in the summer to almost 900 yesterday. So if you're just eyeballing it, this thing could come down to 500 and like it wouldn't, the long-term chart would not be in any damage whatsoever. So a move like this, it could lose 40% and that would hurt. It would sting a lot for people that bought near the top. But it could come down 40% and the long-term trend would still be up.
I agree. Where's the 200-day moving average? It's probably like 350 or something.
I mean, good grief, it's got to be so much lower. Yeah, that's my point. So hang on while I take a look at that. So while I'm looking this up, the market cap of Tesla yesterday passed the entire market cap of the S&P 500 Energy Index. Last week, Morgan Housel tweeted that Elon Musk had a higher net worth than the entire market cap of Exxon.
Yeah, it makes sense. Doesn't it make sense?
So yeah, by the way, great guess. Tesla's 200-day is at 357.
I swear I didn't look that up. I'm just picturing in my mind what I think it would be. So Tesla had like sold off 80 points. Who cares? No big deal. I don't think that I would call that a blow off top. One thing I wanted to point out yesterday, if it were to have put in a blow off top, it would have made sense. Bank of America came in with a new $900 target, and their bull case for Tesla is like the scariest thing I've ever heard. The analyst basically said the higher the stock price goes, the more of a buy the stock is because it's an upward spiral where the stock goes up.
That's been true.
They can sell more stock, which means they can fund more innovation and build more cars with the money. So but Mike, by that logic, every stock that goes up is more of a buy the higher it goes because they can theoretically sell more stock and do more of what they do.
I'm not saying that's a good reason to buy. I'm just saying that's how we got to today.
That's right. No, I agree with you.
Every high attracted more buyers, and that's usually how it works. That's not a good thesis for owning a stock forever and ever.
So they've been doing like these $5 billion when issued secondaries where they just like get approval from the board, like we're going to sell another $5 billion worth of stock, but they don't say when.
Let's move on.
Hasn't mattered yet. Okay, what do you got?
I want to talk to you about social media. Was what we saw a watershed moment. Ben Thompson just did a piece on stratechery about Internet 3.0. He said Internet 1.0 was all about technology, 2.0 was all about economics, and 3.0 is going to be all about politics. So with the removal of Trump from basically everything, is this like a death knell for Twitter? Because let's say that 20% of the people, I'm making that number up, just say, you know what, f*** you, I'm out. If you're going to silence me, I'm leaving. Can Twitter afford to lose 10, 20% of their members? And is this going to cause a chasm?
You have it backwards. You have it backwards. It's not "f you, I'm out" because you're trying to silence me. It's what do the 80% of normal people do if you don't silence that 20? Their employees basically told the board, if you guys don't get these literal Nazis off the platform, Nazis, like guys wearing Auschwitz sweatshirts to riots, if you don't remove this filth from the platform, we're not coming to work. So it's not about, oh, you're going to silencing, like, it's not even 20%. It's like 1 or 2% of users who just cannot act like grown adults and are creating fake accounts.
Fine, but I'm not talking about the counterfactual.
You have to silence them or the normal people leave. And if the normal people leave, then it's a death knell.
Fine.
So I think you have it backwards.
Okay. I'm not sure about that. I have to think about that. But let's talk about what happened. Can Twitter afford to lose a chunk of their audience?
Depends on what that audience is worth to advertisers. Can they lose neo-Nazis? Yeah, I think that's no problem. Do you think that that's the audience that Disney Plus is trying to reach when they buy sponsored tweets?
I don't think it's just neo-Nazis that are leaving the platform.
Who's leaving the platform besides me and QAnon? Who else is leaving the platform?
Is this a watershed moment, or are people making too big a deal out of this?
I'm bearish on Twitter, period, and it's not their fault. I think they've built something that literally cannot be policed, cannot be governed. I think the platform lends itself to outrage and harassment, and it's like the best content is people dunking on each other. That's the stuff that does the best on the site. And outrageous stuff that makes people angry is what gets the most attention. That's literally in the DNA of the platform. I think they're good people trying their hardest. I really do think they want to get it right, but you can't get it right because people are not meant to interact that way.
Well, that's 100% right. China did a study on one of their social networks, Weibo, which is basically Twitter, and they showed how quickly different emotions spread. They looked at joy, sadness, disgust, and anger. And anger and sadness just dominate, not surprisingly. So
so Twitter can't change human nature.
Right.
And so this idea of normal people interacting with people who are hidden behind a fake name and have no laws governing their behavior, like it's not natural. It doesn't make sense.
But it's not just that, because normal people with different views often don't get along at all. Even if they're one side's normal, one person's normal, the other person's normal, and they disagree with each other, they can turn crazy.
That's fair too. And then they become abnormal. You're 100% right. And I don't think that we should be seeking out these opportunities to interact with each other in this way. They don't make sense. People like, why would you take a break from Twitter or whatever? It's like asking me why I would leave jail or why I would walk out of a dark alley. I've had enough. Like, my life is fucking awesome. I don't need that shit.
Did you listen to Kevin Rose's podcast, The Rabbit Hole?
No, I like.
So he did a series on social media and YouTube and Facebook and Twitter, and it breaks people's brains. Like, people did not come into this crazy. They left crazy.
Did you see the look on people's faces being filmed and reporters asking them questions in front of the Capitol building? Like, they look like normal people, some of them, like middle-aged, like 50, 60-year-old husbands and wives. They're screaming at reporters. Like, they're like frothing. There's something wrong with these people. I don't think they started out that way.
I think they were social media.
They were turned insane.
Yeah.
So why don't I spend more time on social media? I mean, come on.
Come back. We miss you.
Nah. Yeah, maybe tomorrow. All right. Worst pandemic habit. I'm just curious. Is there something that you've fallen into that you want to get out of?
All right. This is obviously about you, not me. Come clean. What's up?
It's not about me. I'm curious about you. I've already talked about this.
Give me an example of a bad habit.
Is there something that you've fallen into the habit of doing during 2020 that now that we're in 2021 and the economy's reopening and the vaccine is coming around, is there something that you think you might want to change?
Yes, drinking.
Nothing to do with me.
Okay.
You want to say drinking?
Yeah.
How much are you drinking, Michael?
In 2020.
So not about me.
In 2020, I was probably drinking, like, having a drink, like, I don't know, 6 nights a week.
What's a drink? Like fill a rocks glass?
Yeah.
Okay, that's not really drinking. I mean, no
Well, it
offense.
wasn't. I mean, to me, it was because I never used to drink at home, like ever. I
You
never had a drink.
You never had a drink alone.
Nope, never.
Okay.
And then it would go where like March, April, May, I probably drank for like 40 straight nights.
Yeah, it's so bad.
But just because
you slowed down already, then
it slowly became a habit, and that's how habits form. And obviously, I'm not saying that I was an alcoholic, but that's how it happens. It's easy to see how it does happen. So I haven't had a drink in January. So anyway, I'm sure that's a bad habit I'm trying to shake, I guess.
Because it's not just the drinking. Then you wake up a little bit later, or
it's everything. Because
probably eat something that you don't want to eat.
Exactly. So it's all of the above. And if like I like to be productive. I like to do work. I like to read at night and stuff. And if you're having a drink, then you can't do any of that.
That's it. You're done. You're done. You might think you're going to have a glass of wine and read a book. The wine is going to win. Your eyes are going to close. All right, I think I'm with you on that. I haven't been drinking in January the way that I was around the holidays. The holidays is just like every night a different reason to pop open a bottle.
And for the record, I have no plans to like stop drinking. I just don't want to be drinking during the week.
Oh, I'm with you. I'm drinking right now, but I'm just saying like, no, I think that's my big one too. This wasn't about me. I was just totally curious. All right, what do you got?
All right, I want to talk about the latest Howard Marks memo. What did he call this thing? He called it. Did you read it by the way?
It was really good.
So this was my favorite post memo of his, maybe ever, and I think I've kind of like read all of them and have been somewhat. I feel like he was saying the same thing for the past few years. This was fantastic. I mean, there was so much of this that I loved. I want to read 2 paragraphs, so bear with me for a second. I want to get your response, Josh. So just in preface to this, to lay out what's happened, he's spent much of the pandemic with his son, Andrew, who is a growth investor. Just completely cut from a different cloth. I think he's from his dad. Yeah, exactly. Right. So all right. So Howard Marks wrote, many of the great bonanzas for value investors have come in periods of panic following the bursting of bubbles. And this fact has probably led value investors to be very skeptical of market exuberance, especially when concerning companies whose assets are intangible. Skepticism is important for any investor. It's always essential to challenge assumptions, avoid herd mentality, and think independently. Skepticism keeps investors safe and helps them avoid things that are too good to be true. But I also think skepticism can lead to knee-jerk dismissiveness. While it's important not to lose your skepticism, it's also very important in this new world to be curious, look deeply into things, and seek to truly understand them from the bottom up, rather than dismissing them out of hand. I worry that value investing can lead to the rote application of formulas, and that in times of great change, applying formulas that are based on past experience and models of the prior world can lead to massive error. John Templeton warned about the risk that's created when people say it's different this time, but he also allowed that 20% of the time they're right. Given the rising impact of technology in the 21st century, I'd bet that percentage is a lot higher today.
Right. So businesses have never been more disruptible, but when they are the disruptor, businesses have never been in a position where they could become as dominant. That's a very interesting situation that we're in. And first of all, I agree with you. I think this is like one of the best things Marx has written in years and years. And
let me just say two things real quick. So on the one hand, so Grantham last week did his thing about this is the greatest bubble since, whatever, one of his lifetimes. And Howard Marks, so Grantham is a little bit older, has maybe a little bit too entrenched in his way of thinking. And to see Howard Marks talk like this was such a sign of fresh air. And it's so easy to be a knee-jerk skeptic, and unfortunately I have that in my DNA. I remember being at a Benzinga conference, FinTech award thing with you in like 2014, and I was like laughing. You know what I mean? Like, this is ridiculous. What a party. And meanwhile, some of those companies were probably, I don't know if Robinhood was there, but these were world-changing companies that I was just like laughing at. Yeah.
Because they looked ridiculous when they were in their infancy, and the people who founded them looked like children. First of all, I think Grantham is bearish on humanity, and that's a whole different mindset than Howard Marks. So this is where podcasts are really helpful. And I have a lot of respect for Grantham, but I listened to him talk with Patrick O'Shaughnessy last summer. He did like 90 minutes with Patrick. And by the end, you just said, this guy really doesn't even think that humanity is going to survive. Like, he thinks the earth is like in the process of shaking us off. So why would you why would you want that investment worldview coming anywhere near contact with your money? because you think you're going to avoid the next 30% bear market. Who gives a shit? So that mindset, like, to me, is entirely alien. As much as I respect Grantham and I read his stuff and Ben Inker, Marx, I think, is coming around to this idea that the formulas he learned in the 1960s aren't particularly important. Like, not to be like, I told you so. I honestly feel like you and I and many others have been writing blog posts saying all of this stuff already for almost a full decade now. Like, do you think I'm presumptuous about that? Am I wrong about that?
No, and maybe it's confirmation bias on my part because we've been writing about the rising CAPE ratio since
we've been stomping on the CAPE ratio,
and to see maybe I don't want to say Mark's coming around to our way of thinking because it sounds so ridiculous.
No,
but
I don't mean that.
It feels good. I'm not gonna lie.
I don't mean that, but I was on the Earn Your Leisure YouTube show last night and podcast. Shout out to Earn Your Leisure, and valuation came up, and I was just like, I was riffing. But I was like talking about like this idea that people say, oh, this stock is 10 times earnings. That stock is 40 times earnings. 10 is cheaper than 40, buy the 10. Like, if that's the level of thought that's going into the way that you're orienting your portfolio, like, there are horses in carnivals that can do that math with their hoof, 10 less than 40. Like, is that what we're doing here? So I think one of the things Marx gets at but doesn't go deep enough into is being creative versus being good with, like, a qualitative analysis of companies versus quantitative. You look at the two most successful investors of our time, both of them are incredibly creative and good at qualitative analysis. They can see the story, and one of them is Chamath and the other is Cathie Wood. And it's not that they don't have numeracy and they can't do calculations. It's that they understand that calculations aren't the answer, right? I think a lot of smart beta strategies and factor investing, they just stop at calculation. And the creative aspect of investing is just completely lost on them. So maybe that's an edge, is coming to Wall Street, not just as a math person, but as an artist. So, all right, I would say, and I don't think you would disagree. Hold on, last thing. Finding the person that has a qualitative edge is like good luck. Oh, I agree with that too. Or one that's enduring. Next? This is a quick one. Venture capital versus private equity, which is going to be the bigger disappointment of the 2020s, and you don't get to say neither.
Private equity. I think this is easy.
Why?
I think this is easy. Private equity. Just because valuations are so much higher, and I think so much of the returns come from starting valuations.
They're buying.
I understand there's tons of froth in VC too, but to me, this is easy.
I think you're right. Here's why. Venture capital raised $69 billion in new money last year, which is a lot. It's a record. The prior year was $56 billion. So, but $69 billion in general is not a lot of money. It's a lot of money for the size of the companies they're investing in. They're investing in tiny things, but it's not big. Private equity started 2020 this time last year,
Trillions?
1.5 trillion in dry powder. And then they spent the rest of 2020 raising even more money. I think they raised another 500 billion or something. So not only are they now competing against themselves with all that money, now they're competing against SPACs, which have also raised, I don't know, hundreds of billions. And SPACs have a cost of capital that's effectively zero, doing private equity-like strategies. So I think you're going to be right. And I think PE funds, I can't imagine them having the same kind of run that they went into this decade with. All right, that's all I got. What do you got?
All right, lastly, I want to talk about micro bubbles. Some are not so micro anymore, but Trump, Musk tweeted, use Signal. And this company, Signal Advance, it had a market cap of like $6 million, just tiny, just went vertical, was up like 500%. The next day was up 30%, 90%. Yesterday was up 300%, whatever it is. So this company, Signal app, it's an app. That's what Musk was referring to, tweeted. Is this what stock analysts mean when they say the market is giving mixed signals? And they show a picture of this company, Signal Advance. It's understandable that people want to invest in Signal's record growth, but this isn't us. We're an independent 501c3, and our only investment is in your privacy. I also want to point your attention to, so we mentioned Chamath, who's obviously got the golden touch. He announced that he's taking SoFi public through a reverse merger, which is a big deal. So IPOE, the shell that it's, or the SPAC that is coming public from was up 20%. But then he's got these other SPACs that have not merged yet. They're just blank companies, IPOD and IPOF. They both ripped, which I guess makes sense because you want to get in ahead of what Chamath is going to do next. But there is like speculative fever running rampant right now.
I think he's the new Buffett, Chamath, because he has figured out how to have the zero cost of capital and the endless money coming in. And everything he touches is just like it turns to gold immediately because he's had past success. It doesn't mean that some of these SPACs won't fall off a cliff when the operating business screws up. Like that's inevitable. But I got to tell you, I've been around him in person. Like he's done Halftime Report. We've been down at the New York Stock Exchange. I remember this is like 3 years ago. We did a segment and everyone around the desk was trashing Bitcoin. I was the only one sitting there that owned any. Not that I have a lot. And there's a commercial break and he just like leans over and he goes, Josh, stop listening to these people. They stopped learning 20 years ago. Like that was, it was almost like a priest or a rabbi, like giving me permission to think my own way.
He's very,
dude.
He's
he
very
has
charismatic.
That aura about him. I think he's like the new Buffett. So
he's trying to be. He was talking about that with CITES on Capital Allocators.
Well, he's not there in dollar terms yet, but I mean, he seems right now to have figured out a lot of things before other people, and he's executing very well. So I don't want to short one of his SPACs. I'll tell you that much. Duncan, let's do some viewer topics.
Okay, hey guys. First up today, Joseph writes, for you, Josh, what happens to a company when a large number of its shares are sold? Does the company immediately have less money to run operations?
So not exactly. When a company has a lot of its shares sold, that means they were sold to new buyers. So the stock is changing hands, but that doesn't affect the cash that the company has on its balance sheet. The company has that cash on its balance sheet through a mix of having originally sold those shares in an IPO and funds from operations. So just the normal cash flow that they generate. So I would not look at a stock having a lot of people selling as though it's really going to impact the company unless they're counting on a high share price to sell more stock and fund their operations, which is what we're talking about with Tesla before. So I would keep those two things distinct in your mind.
Okay. And so then for you, Michael, Abhishek writes, what are your thoughts on collectible investing? Things like wine, whiskey, watches, sneakers, Pokemon cards, etc.
Do it. Buy it all. Buy all of it.
They say, is this a result of TINA, which I learned means there is no alternative, or general diversification?
I would say that this is a result of two things. One, technology, and two, zero interest rate policy. So for example, I was very happy to have my money last year in a Marcus high yield savings account, high yield, giving me 2.25%, whatever it was. Now at 50 basis points, I'm taking some of that money and I'm moving it to collectible art at Masterworks. I'm doing like all sorts of stuff with it that I probably wouldn't have otherwise. I'm doing income share agreements with Edley. I'm doing all sorts of speculative investments that I probably would not have. So I think that it's technology and more importantly, zero interest rate policy.
The 10-year interest rate, I think, is up 6 days out of 6. It is now back above 1%. These people are out there buying a lot of garbage. They're not even buying the garbage physically. They're buying shares of it digitally. None of this shit's going to be worth anything. The baseball card thing will pop.
I don't know about that.
Yes, it's all dumb. It's all dumb. And you probably need rates at 2%
now
in order
you're
for that realization to dawn on people.
You're starting to sound like Howard Marks in 2019.
Not to be a dick, but buying digital shares of someone else's collectible, just give it a charity. Stop doing stupid shit. All right, that's all I got for today. We want to tell you guys. Listen, that's why I do the show. I'm keeping it real. Listen, we want to tell you guys that that we love you all showing up for the premieres. It's so great. We have so much fun with you. Come back every Tuesday night. We typically premiere around 5:30. Make sure you're a part of the chat and make sure you're part of the comment section below. Give us a like if you haven't already. Make sure you're subscribed to the channel. Michael and I will see you next Tuesday and the Tuesday after that and the Tuesday after that. Let's keep it coming, and let's have a great 2021.